just do this and make host. All right, cool. All right, so welcome everyone to the weekly newbie coaching call with me. My name is Amir Khan. These weekly coaching calls are obviously on Thursdays. They are short. They are exactly 40 minutes. So please be aware, we have a hard stop at exactly 40 minutes. Now, the format is some weeks I have a topic that I talk about. I choose the topic. It is geared towards newbies, so we don't talk about any advanced concepts at all. We focus on newbie fundamentals of slow flips. And some weeks I have a guest. Today we have a guest, and it's going to be very, very helpful for everybody in the community. Mike Grizzle is here, who is the guy for insurance questions. And so he's graciously accepted to be here. I want to make sure Mike, oh, there you are. Okay, cool. So before I do that, let me just give you a quick update on our latest project that we have for newbies going on. It's called a newbie pod. And so let me remind you what it is. It's a program through which we have an accountability group for newbies. And what that means is that if you are a newbie and you've been in the program, you finished all your training and you're still having problem buying your first slow flip, as long as you have funds, at least for one slow flip, you can join the pod. And what that will do is help you with the community. And there's a pod leader, Beth Hoffman is leading that pod to help you go over that huddle that you're having. We already have the first part in place. We have 5 people that have joined that pod, and they are, I'm going to pronounce your name. If I don't pronounce your name correctly, please excuse me. Kenny Thomasian, Eric Patterson, Tim Shigru, Jin Wang, and Michael Schock. Now, what that means is even though we have these 5 people in the pod is small, there are only 5 people, we are still accepting applications. So if you're interested, there's no fee for this. This is a program in our community. And Beth is also doing this as a volunteer basis, just like I'm volunteering to be on these calls. So you can still apply. Everybody's on a wait list. And as people graduate, which means as soon as they buy one property and they feel that they've learned enough, they're going to exit the pod. So which means we're going to open it up for more people. So you can keep applying. Major, would you mind putting in the link for the posting for the pod? So if anybody's interested, they can apply. All right. So having said that, I'm not going to waste any more time. Mike, welcome. Go ahead and unmute yourself. How are you, sir?
I'm good. How you guys doing?
Good, good. You know, you are a very wanted person in a good way. All right. So what I'm gonna so what I'm gonna do is I'm going to limit my questions. I think the main purpose of this is so people in the community can ask questions. So please go ahead and raise your hand as early as now. Go in Zoom and choose React and raise your hand. And as soon as your questions come in, we'll go ahead and start asking questions. So Mike, let's just start with some basics. Let's start by talking about insurance coverage fundamentals. So in other words, let's stick with what our core model is. Let's say somebody's buying a home, slow flip home for 30 grand. What are the options? I know it's a very broad question because location and all these things are, so that's what we want to understand, all right? But let's just say somebody is looking for a property, and you can pick a city or state or whatever and give some examples. What are the options in terms of coverage? And also we're going to there's so many different questions, but let's just start with that first.
Well, the from the get-go with the way Scott promotes it is obviously buying homes 25, 30 grand or whatever the number is going to be, and then ultimately getting coverage on the home. And then if you have a private money lender, for sure get a policy with enough coverage to satisfy your private money lender that the owner of the home is going to keep at least for the 5 years of the duration of their loan. So that's kind of the baseline, I think, where what Scott recommends. So the actual cash value approach is what he's recommending, not replacement cost. Most of these homes, based on the value of the homes in a given area, if you get a replacement cost policy, the insurance company is going to push for replacement cost value, which is going to come up probably 180 to $40,000 per square foot.
Can I ask you to please give us, for everybody's, even for myself, the clear explanation of the difference between replacement and cash value, so we understand that really well.
So the actual cash value is going to be that the actual cash value of the home. So if you're buying it for $25,000, $30,000, and you get an actual cash value policy, and there's a claim, there will be depreciation normally that the insurance company is going to look at. As far as the year of the roof, the life expectancy of the roof, they're going to take those things into consideration when it comes claim time. Versus a replacement cost policy is going to be new for old, regardless of the age of the roof or whatever was damaged. It's always going to be new for old replacement as long as you replace it. Even if you have a replacement cost policy, even on your primary residence, maybe where you live, and you have a claim, if you choose not to replace it or get the repair replaced or rebuilt, and you tell the claims department, I'm just going to take the money and I'll do whatever I want to do, they're normally going to pay you on an actual cash value settlement. So you're going to get an ACV settlement, even if you're paying for a replacement cost policy. So, but the actual cash value normally is going to be depreciation, and it's going to be the settlement is normally almost always going to be less. Well, it will be less than what the replacement cost method would be. But the actual cash value policies are going to be cheaper than a replacement cost policy. And the values that we're trying to insure these homes for, most insurance companies will not do a replacement value on the lower amount of coverage because they're going to base it off the rebuild cost of the home. So if you pick a $30,000 or $40,000 or $50,000 policy, the rate will be based off of the year built, square footage, condition of that property, the location of that property comes into play as well. And then you pick most of these policies that people are purchasing. It's going to be a $5,000 deductible. It'll come with either $500,000 of premises liability or $1 million, depending upon the carrier. Loss of rents or loss of income is included. So in the event there's a claim there, you're not able to receive the money you're getting in the way of a monthly payment from the tenant or a tenant buyer, and you have a claim, the insurance company is going to pay you for your loss of income during the period of time that claim is going on until the claim is settled. The couple of areas as far as right now in the country, not that the countries are getting saturated in. St. Louis is one, and due to the market and crime, vandalism, the devalued neighborhoods, Detroit is another city that a lot of the companies, when I put an address in with Detroit, I get a big red flag, do not quote this. So I would look elsewhere. Plenty of cities in Michigan that you can get good coverage in, Saginaw, Flint. There's a whole bunch of them. Detroit seems to be the only area that is kind of red flag in the minds of the insurance companies that I run into. And now St. Louis is starting to get some of the market saturation from the carriers. NREIG is one. They're right now they're not quoting anything or taking any new business in St. Louis. Steadily will hit or miss on the rates. OB Insurance, we've written, I'd say definitely the vast majority of policies that I've helped place the last year or so have been with OB Insurance. They were real easy to do business with. They were not doing inspections. Now they're doing 100% inspections. They're no longer, they would do the $50,000 policies. They're no longer looking to do that. And now they're pushing $200 a square foot in most cases. They're wanting to get more premium, out of the policies than what they were before.
All right. So let's talk about that inspection. So you and I also talked about it several times, is that most of them, I'm assuming, most of the carriers are doing either drive-by inspection, right? Or they're asking.
Most of them are doing in-person inspections.
In person, okay.
And then visual imaging. And even when I quote a policy, I have a satellite view or an image that I go down and look at the property, and I look at the roof. That's the first thing I look at. And if it's got a bad roof, if I can tell it, I'm not going to quote it because it's going to be a waste of time. The insurance company is going to cancel or decline that application. And NREIG is one. First thing they do when I submit something, they get online and they look at the image they have on whatever viewer they've got, and they'll send me an email, or the gal Christy is one of the underwriters. She'll call me and say, hey, it looks like the roof is old, deteriorated. Do they have plans on putting a new roof on it? So that's definitely one thing out of the gate. If I'd say, especially for a newbie, if you're buying a home, do your best to find a home that's got a good roof. So it's not going to be a problem for the insurance company to do an inspection. It'll pass inspection and you're not going to have any issues with it. And then later, if you go to sell that home to a tenant buyer, the tenant buyer won't have that problem either of getting coverage on it because it's got a good roof. But if it's got a bad roof, it's going to have a bad roof. And my experience has been with the types of tenant buyers we get, they're not going to be financially in a position in most cases to go and spend 10 grand to put a roof on a home.
Absolutely.
So
Thank
get
you.
a good roof.
Excellent. All right. So we have some questions. So Michael, go ahead, please unmute yourself.
Hey, thanks for doing this. So it sounds like you're kind of not recommending St. Louis, is that right? Because it's saturated?
Well, you can still get St. Louis, but it limits the number of companies that will quote there.
Okay.
So it just depends. But I would say if you're getting a home in St. Louis, get a very nice house and one that's been remodeled, a great roof, maybe new windows, that type of thing. Because don't give an insurance company a reason not to want to quote something or at least keep it on the books at renewal. Because I know with Steadily, if they take a policy now, next year they're inspecting it, and then 6 months later into the next term, they're doing another inspection on that property.
Yeah,
so
but
if you got a roof
not,
that's kind of iffy, it's not going to get better. So make sure you get one with a really good roof.
But we're not buying remodeled houses. I mean, you know that, and we're buying arguably livable houses that need lots of work. I mean, I understand your point about maybe the house at least having a good roof. If that's the best part of the house, it's going to be the roof, but the rest of it arguably it's going to need a lot more work all around.
There are nice houses out there for 25 and 30 grand. I get them sent to me every day.
Yep.
Really? Okay.
And I get people that are buying $25,000-$30,000 houses that are beaters. You wouldn't live in it. I wouldn't live in it,
Right. Okay. So
that's why Scott says buy the best of the worst and look at 100 before you buy one.
Okay, so this is something I've got to get through my head. See, I'm in the Boston area where this just, all my entire life, I've never seen $25,000 houses, right? So, okay, so you're saying they're out there, and
they're out there.
Just make sure you get something that's insurable. All right,
Yeah.
I'm going to have to take that. Thank you.
Thank you.
All right, cool. Next is Jack. Go ahead and unmute yourself, please.
Hey, Mike, and thank you so much for being a part of this tonight. Could you, and I know Scott's brought your name up, and I am fairly new to this, but I'm a veteran of the real estate business for 40 years, and I've got rental properties, et cetera, but I've enjoyed keeping up with Scott and joined the program several, probably 7 or 8 months ago, and I've heard your name several times. Could you maybe, for us that are new to you, can you give me your background of what company you work for, where you're out of, exactly how you go about helping all of us do what you do, so that we can kind of help you along the way as well?
Yeah, I'm just outside the Phoenix market, and I'll be 60 years old my next birthday. I've been doing insurance since I was 22 years old. So I was an Allstate agent for 34 years. Now I'm an independent agent. I'm a broker. And so I try to find, when a house comes in, I try to find the carrier that I know is going to be the best fit potentially for that home. Now, when you have properties that, like I said earlier, if it's got a bad roof and the buyer has no intentions of putting a roof on it, I can't place it anywhere. No insurance company wants that property. However, if you buy a home and it's got a bad roof, and there are a few people in the group that will go in and remodel these homes, and they make them very nice. But if you get one, you get a smoking deal on one, and you don't mind investing the money into the home to get a roof on it and whatever you're going to do. I've got a couple of companies, they will do a renovation policy, and it gives you all the same coverages that the traditional policy gives you, and it's rated for it to be vacant while the repairs are going on. I write a lot of those for people, and the rate is very competitive, and you keep that policy. It's a 12-month policy, and you keep it for the number of months that you need it while the repairs are being done. Then when the repairs are being done, we convert it to a regular landlord policy, take pictures of it, send that to me, convert the policy over to a full-blown landlord policy. And then, then you've got a good property. And I always tell people too, even if you have to repossess that home, tenant buyer stops paying, they move out, they're not taking your roof. You're always going to have a house that's marketable. It's going to have a nice roof on it. The next guy that comes up is going to have curb appeal, and they're never going to have to worry about putting a roof on it again. And neither are you in the event of it, unless a tornado or a fire or something happens on it.
And as far as
I try to put those with the companies that I have access to, and there's only 4 or 5 companies that want these things.
do you handle all 50 states?
I do.
Okay. Can you share your contact information as well?
It's on school. It's in the group.
Okay, very good. All right.
Mhm.
Thank you so much.
You bet.
Cool. And before we take the next question, I can attest that I have, since I've started working with Mike, which is now, since I've joined pretty much, I've gotten the best rates, the best service, and the knowledge. So you can't go wrong with that. And that's why everybody pretty much uses him. So, all right. Next up is Eric and Mary. Go ahead and unmute yourself, please.
Yeah, I've got a question regarding the roofs. Are you also looking at like detached garages and stuff like that? How the roof is looking on that one, or just particularly the house only?
Traditionally, the carriers, if you want coverage, well, NREIG is one company. They will allow you to exclude coverage on a detached structure. And that's one thing that they always look at. They pull that up, and then they'll ask in the application, is there a detached structure on the property? And if it is, they want to either have to add coverage or exclude the coverage. But traditionally, if an insurance company, any insurance company, if they do an inspection on that, if the roof on the garage is bad, they'll decline that policy. So they want the roof on the house to be good as well as the detached structure to be good, or they may decline it. There are some companies that will do a detached structure exclusion. I don't like exclusions in policies. It's because it's kind of a gotcha. And sometimes people forget they sign exclusions later on, and it's lose-lose. Nobody wins. Puts the agent in a bad position, puts a policyholder in a bad position when it comes claim time. But to answer your question, yes, if the roof has a good roof, make sure the garage has a good roof on it.
Okay, all right, thank you.
Okay, great. Next up is Jason. Go ahead and unmute yourself.
Hey, Mike.
Hey, Jason.
You've been pretty helpful to me so far, but I just wanted to ask a question, probably for the benefit of the group. Age of the house, unremodeled. Those could be 2 separate factors. We talked about 1940 and up is the line. How about a remodeled? Is there a remodel that can move that line down? And I know there's some fluctuation.
You can get with most of the companies. There's a couple of companies that won't take a home. I'd have to, and their year built will change from time to time. But if you find an older home, because we've got a bunch on the books that are in the late 1890s, but it's been totally remodeled. It's got a good roof, got all new electric, all new plumbing, all new heating, new water heater, everything, all the mechanicals are remodeled and up to date. And as long as I can get photos of that, the companies will take those. So it's just, they look at those individually. But with most of them, if it's especially steadily insurance older than 1940, they're going to ask a lot of questions. And so they expect all the mechanical systems to be remodeled, no knob and tube wiring, all electrical panels need circuit breakers, no screw-in fuses. The plumbing, they want all up-to-date plumbing. That's why they want me to get photos of a water heater, photos of, if it's got a basement, look up and take photos. If you have boots on the ground, have your boots on the ground getting these photos. So you know what you're buying, and then you know what you're dealing with when it comes to getting insurance. But if the home is older and those systems have all been updated, it's not a problem as long as we can substantiate that with underwriting with photos. They don't have a problem with it.
Very good. Good clarification there.
But with steadily, if it's newer than 1940, I don't have to give them a specific year of the roof, of the roof, the mechanical, the electrical, the plumbing, or the furnace. I don't have to nail down a date. But if it's with steadily older than 1940, they want a year. I got to give them a year. That's why I ask you guys, hey, give me a year. I know you don't know exactly either, but we got to kind of ballpark it. And that's the best we can do on some of those when you're buying it. And the underwriting department knows you didn't do the work, because you're buying it that way, and always indicate that in the application with them. But sometimes it depends on the underwriter that I get on the other end, and I don't get to speak with them. It's all electronic chat. So I don't have a way of speaking to them, getting a feel for, you know, how they're going to accept what I'm going to tell them or not. They give me the date, give me the year, give me the year. And then when they go out and do inspections, they're not going inside the home. They're only doing external inspections. And usually they'll get rough measurements. They'll definitely get photos of the roof. They'll use a drone many times, fly up on the roof, take an image of the roof, make sure it's good. No broken windows, no boarded up windows. If you got a house with a porch, a couple steps, make sure there's a handrail coming off of it on one side, because I've had them decline that. If the roof has a tremendous amount of leaves, get the leaves off the roof. They don't like seeing that either. And then they also go online and they're looking at these MLS photos online with the listings, and they're looking at the same images that I get. So if those images look bad, make sure you're getting new images that are current if all that stuff has been remodeled or updated, so I can send that into the underwriting department. Because many times I'll put the address out there, and while I'm waiting to get back, they're going online looking at those photos, and then they'll either decline it right up front because they don't like what they see, or they'll hit me up with the photos. They'll give me a chance to send that. And something else, when you guys are buying these, pay attention to what is next door. If there's a boarded up crack house next door, a lot of these companies will shut it down. They say, nope, we don't want that because that house is going to catch on fire and it's going to catch your house on fire. So be aware of that. I haven't had a lot of issues with that, but I know they do look at that.
Very good. Thanks, Mike.
Okay.
Mike, that's a great input on that. Let's talk about that a moment. So if there is you also have many cities where if a house has burned down, they clear it up,
Yep.
right? Do you have any problem from an insurance company when you have a home and then there are no other homes around it because maybe they had burned down? Is that an issue?
That's not really an issue because it's not a liability hazard and a potential fire waiting to happen to catch your house on fire. So they would rather see a vacant lot that's cleared than see a house that's in bad condition or boarded up. They would rather see it just to be a dirt lot, cleared out with no issues. And a lot of these in these older neighborhoods, you get in there and look, there'll be a house, and then like 2 or 3 empty lots, and then another home. And I know there were houses there one day, but they got burned up, or
Exactly.
the city came in and demoed, and that's great. That's what
Oh, okay. Well, that's great. Thank you very much. All right. Next up is John. Go ahead and meet yourself.
What's going on, guys? Mike, nice to meet you. I've got 2 policies with you, so I appreciate your help on those 2. Question about, I know everybody does it a little differently, right? Where I have just basically a $50,000 policy I call kind of like, structured policy, so to speak. And then I'm telling the tenant buyer to go and, get renter insurance or whatever the case may be. If my tenant buyer wanted to go and get an actual true like homeowner's policy, could I send them to you essentially and you sort of help them with that, or are these?
I usually encourage them, call the insurance company they have their auto insurance with first.
Okay.
Because they may get a bundling discount, and it may be State Farm, Farmers, Allstate, one of the traditional carriers. And if your house has a good roof on it and that house is in good condition, it'll probably pass their inspection as well. And they're probably going to get a better policy, probably at a lower rate than it would be with a non-standard or what they call non-admitted carrier.
Yeah.
So I would encourage that, before they call me. I can quote it. I've got access to Farmers or Travelers Insurance, Safeco, Nationwide. I've got probably 5 or 6 companies in most given states with home insurance. The thing I run into a lot of times, they're all credit-based rating. And then when I get the information from the tenant buyer, if they have credit issues, usually the rate will come in higher. And depending upon how bad their credit is, and I don't see their credit, it'll default to a certain score. And as soon as I hit the button and put the coverage in, I can tell they've got their credit's probably not the best. But on the flip side of that, the insurance company they're going to, and even including when I quote it, the carrier is going to want to put the replacement cost value on that. And based on the square footage, it's probably going to come in at $200 a square foot or more, which may make the rate $3,000 or $4,000 a year if they don't have good credit. So a lot of times that's when they end up going back and buying a renter's policy, because a renter's policy is going to be $250 to $300 a year. And they can make monthly payments and name you or your entity as the additional or an interested party on that. That's usually going to be the cheaper way to do it, because if they go out and get a traditional homeowner policy and their credit's not good, it's going to kill the deal because their homeowners insurance is going to be $300 a month or more. So it kind of just it varies. Now but if they do have good credit, I do see some of them. The rate will come in at even with a higher coverage amount, it will come in at $1,800 a year, and they're good with it. So it just depends on that buyer.
Yeah. So second question is, I think we're all kind of trying to find the right way to do it. Whereas, if I have a structure policy and total loss for whatever reason, I have enough to pay back my lender. I understand that. But then any sort of equity the tenant buyer paid into it, they're wiped. They've got nothing. So the idea would be to put at least enough coverage on it to like pay off my lender and then maybe give a little bit of their equity back. I don't know. If you could speak to that on like what do you do in a total loss
Well, I'm
scenario?
seeing more and more where people will put the amount of coverage on their sell price up to the amount of that, the coverage up to the amount of that sell price. So if it's 79 or 89, whatever it is, something happens to the home, they've got enough money there, potentially. Now the insurance company is going to pay up to that amount based on a market valuation and an appraisal normally. So just if you get an $89,000 policy, doesn't mean they're stroking you a check for 89 grand. It's going to be up to that amount based on that house, year built, square footage, condition of the property, all that stuff lends itself to the higher value, even if it's an older home. In this case, you may want to have the best house on the street when it comes to valuation for your property in the event you have a total loss. So it
So if
can
it
go
doesn't
either way.
appraise, what if
That's the way
I
I do it and the way I believe in it. So I'm getting the most I can get out of it. Pay my tenant buyer, or really you're going to buy them another house. You're not going to rebuild that home. You're going to go buy another house. And if it works out, if they've been a good tenant buyer, keep the terms similar, let them get into the new home and get on down the road with it. And I think that's probably the best you can hope for.
What if it doesn't appraise? We sell it at 79, but it doesn't appraise for 79. But I have a $79,000 cash value policy on there. Would I still get the 79? Because
you're not going to get necessarily the 79. So your deductible would come out of that.
Right.
And then the insurance company, they're going to run comparables. They're going to get an appraisal, all that type stuff. So that can be a number that, it can be, it could come back at a higher number. I've seen some of these where there have been claims they've paid the policy limit right away, and the person only paid 22 grand, 23 grand, 30 grand, and they've insured it for 79 or 69. I've seen, a few of these right away. The insurance company comes out and they have their calculation and they go, here's the actual cash value of the home. This is how they're doing it. So when you have items in the home, if you have an older home and you've put a new roof, you put new flooring, there's new paint, there's new this, there's new that. All of that stuff lends itself to a higher value. If the adjuster is out there, even on an actual cash value claim, if most of these items or many of these items are new, there's not going to be taken much depreciation off of the value, the purchase price of those items, including the labor that you spent to get the updates done on that home. So definitely if you have anything done to it, keep the receipts, and that lends itself to a higher value.
Okay. Thank you, Mike.
All right, so we've just got 10 minutes left, and so let's just see as many questions as we can get. So next up is Jess. Sorry, go ahead, unmute yourself.
Hey, thanks, Mike, for being on here. You actually just answered my second question regarding the actual cash value up to what the buyer is paying. Now you were talking about the roof as one of the first things that you guys look at. So when I'm evaluating like a wholesale deal or a deal on the MLS, is there a way that we can access those images to make a judgment before we go ahead and close on that place?
Well, use Google Earth. I mean, I have a system that I use that's proprietary to us, but I would go on Google Earth and get imaging. And even with the system that we've got, depending upon when the images are taken or there, I can look at it in the winter, I can look at it in the summer, with or without the trees and the leaves. So you can kind of get a glimpse of that. And normally in the roof, what I look at is variations of the coloring, that type of thing. And occasionally, if it's really clear when the image is there, I can zoom right in on it, and I can tell if there's lifted shingles, I can tell if there's missing shingles. If it's got a flat roof, make sure ideally that roof looks white. They put the elastomeric coating on it and maintain that roof. That's why it's real important to get boots on the ground when they're going through the house. have them go through with their camera, take their time, and have them zoom up to the ceiling and look for stains in the ceiling. Because if you're seeing staining, you know that roof has been leaking at some point. So that's the most important thing. And when I have images sent to me, or if I have to get those and send to the underwriting department, those are the things they're looking at: is staining in the ceiling. They're looking for shingles missing off the roof, curled up shingles, broken windows, boarded up windows, liability hazards in the yards. They don't like swimming pools that are empty or green. Just overall pride of ownership in the property is what they're looking for. Now, if they do go out and do an inspection and they find an issue with it, they normally will send me an email, or they'll send you an email, and they normally give you time. Usually it's 30 days with most of the companies to get those things fixed, and then send in photos or receipts showing it's been completed or repaired or replaced, and then they'll continue on with the insurance.
Okay. All right. Well, one caveat to that is obviously it's the date of the image that the Google Earth took the image of that, right? So that could be a bit outdated.
Yeah, it could be. That's why the current photos are really important. And with the boot, if you have people doing boots on the ground, have them take a ladder, lean up against the roof, especially if they can get up and do most of it, kind of take pictures of the roof so it gives you an idea. Because as a buyer, you want to know what you're buying.
Yeah, I mean, it'd be worthwhile to get them a drone. Maybe
it would. Yep.
They get
It's a cheap drone to get up there and fly up, take a few photos, and send it to yourself or whoever's getting it. Because to me, I know what I know and what I see, and I've been doing investing for 25 years. I got a bunch of traditional rentals still as well. The roof is the first thing I look at, and all the other stuff, wear and tear, the pipes and drains, certain things, those are an easy fix a lot of times. But the roof is going to be, if you're buying that, factor in the money to put a roof on the thing that's got a bad roof, or walk that property, go find another one that's got a good roof. And that's going to put you in a better position to market that house, and you're not going to have to mess with that roof down the road.
Okay. Same applies to like Decatur and Peoria, Cahokia.
Anywhere.
And okay, gotcha. Okay, thank you so much, Mike.
Yeah.
All right, next up is Hona. Go ahead and unmute yourself.
Hi, Mike.
Yeah,
this is Anna. Mike and I are, just for the benefit of everyone, I'm working on my first deal right now, and Mike is helping with insurance, and I'll say that he's been super helpful. There's a claim that came up with the insurance and going through that, so he knows a lot about this, worked with a lot of people, and so I've had a good experience thus far. So we haven't closed it yet, but we're getting close. My question was about, you talked about the renter's insurance policy for a tenant buyer. What are the ramifications if the tenant buyer has a claim against your insurance and they pay the $5,000 deductible or whatever it is that's stated in your tenant buyer contract? What are the ramifications to the insurance policy, especially if you own multiple under the same business entity?
Well, what could happen now, if you have policies already on the books, a claim that you have on one is not going to have an effect on your other policies that are on the books when they renew. So the insurance company, the policy that property is under, you may lose a claim-free discount when it's renewed. If it's renewed, most of the time it would be renewed unless if the adjusters go out there and they see all kind of property concerns and there's problems with the home, they're gonna put a note to underwriting. They put what would be called a UR code, underwriting referral, to non-renew that property because of the overall condition. But if you have a claim on that and the claim is paid, it may have an impact on the rate you're going to pay on future properties when you go to get insurance with that company or any company. There's a database out there called CLUE, and it stands for Comprehensive Loss Underwriting Exchange. The insurance companies share that data in a database, and then when someone's applying for insurance on that property, it's going to pull up a claim or any claim activity to that address, just like the home you're buying, and that one pulled up, the State Farm's got the open claim, right? So that's how I found out about it. So it could have a negative impact cost-wise on any other properties that you go to buy later on. So ideally, it is the ideal situation would be you get a tenant buyer that can get their own homeowner's insurance on that property. And that way, and then they list you or your entity as the mortgage holder and an additional insured, and they have that claim, it's on them. It doesn't have a negative impact on you.
Right. And I know you talked about the issue with credit and stuff in the properties that you are helping people insure. How likely is a tenant buyer going to actually be able to get a homeowner policy instead of just a renter's policy?
I would say, well, they can all qualify for it. Most of the time, it's being able to afford it because the
Okay.
rate can go, if they have acceptable credit, no prior claim history, the rate may be, could be $1,000 a year. If they got a horrible history or horrible credit and the insurance company scores it that way, I've quoted a few that have been $4,000 or $5,000 a year.
Wow.
And the house is just a basic house. And it's not so much the home, it's them.
Okay.
Buyer.
Well, that's helpful to know. I was just trying to figure out how I'm going to navigate this on the other side of closing, what I was going to do for the tenant buyer. So
by far, having them get a renter's insurance is the cheapest way to do it. But even with that, I've helped a number of people get renter's insurance that are tenant buyers. They keep the policy a month or two and they quit paying on it.
Gotcha.
So it's
And
just, I'm not sure if it was Sabrina or whoever said it in the group. They're buyers in training, they're homeowners in training. Well, I think that's well said.
That's a good way to say it. Okay,
Yeah.
thank you.
You bet.
Mike,
All
I
right,
got a fast question.
we got time for just one quick question. Last question, Michael, go ahead.
Yeah, this is fast. Okay, back to Scott Dunn's. He's got a private money lender, a $50,000 private money loan. He has a homeowner's policy on it. His tenant buyer also has a homeowner's policy on it for a property that's worth $70,000. They purchased the house for $80,000. House burns down. There's two policies on it. Who gets paid, and does that work when there's two policies on a property?
Well, it depends on who files the claim. Now, both insurance companies, traditionally, what could happen, they call it a coordination of benefits. So if it's come to light that there's two policies and there's $80,000 of money that's owed, rightfully, then many times both insurance companies will pay, each will pay 40 grand.